Students, friends, today we are going to discuss about the cash balance approach of money. Cambridge economics Marshall, Pigou, Robertson, and Keynes formulated the cash balance approach quantity theory of money. Like value theory, they regarded the determination of value of money in terms of supply and demand. Robertson wrote in this connection, money is only one of the many economic things. Its value, this value is primarily determined by exactly economic things. Its value is primarily determined by exactly the same two factors as determine the value of any other things, namely the conditions of demand for it and the quantity of its valuable. The supply of money is exogenously determined at point of time by the banking system. Therefore, the concept of velocity of circulation is altogether discarded in the cash balance approach because it is obvious the motives and the decisions of people behind it. On the other hand, the concept of demand for money plays the major role in the determining the value of money. The demand for money is the demand to hold cash balances for transactions and precautionary motives. Marshall wrote with regard to the demand for money. But let us suppose that the inhabitants of a country find it just worthwhile to keep by them on the average ready purchasing power to the extent of 10th part of their annual income. Together with a 50th part of their property, then the aggregate value of the currency of the country will tend to be equal to the sum of these amounts. Thus, the cash balance approach considers the demand for money not as a medium of exchange but as a store of value. Robertson expressed this distinction as a money on the wings, money sitting, it is money sitting that reflects the demand for money in the Cambridge equation. The Cambridge equation shows that given the supply of money at a point of time, the value of money is determined by the demand for cash balances. When the demand for money increases, people will reduce their expenditures on goods and services in order to have larger cash holdings. Reduced demand for goods and services will bring down the price level and they raise the value of money. On the contrary, fall in demand for money will raise the price level and lower the value of money. Then the Cambridge cash balance equations, what it explain the Marshall equation, what it explain the Pigou explain, what it explain the Roberts equation, what it explain the Keynes equation are discussed as under. So first one, Marshall equation. So Marshall did not put his theory in equation form, it was for his followers to explain it algebraically. Friedman has explained Marshall views. Thus, as a first approximation, we may suppose that the amount one wants to hold bears some relation to one income. Since the determining means the volume of purchases and sales in which one is engaged, we then add up the cash balances held by all holders of money in the community and express the total as a function of their total income. This is the Marshall equation explained. And then we are going to discuss about the Robertson equation. To determine the value of money, its reciprocal the price level, Robertson formulated an equation similar that of Pigou. The only differences between the two being that instead of Pigou, total real resources are Robertson gave the value of total transaction T. The Robertson an equation is M is equal to PKT or P equal to M divided by KT, where P is the price level, M is the total quantity of money, K is the proportion of the total amount of goods and services which people wish to hold in the form of cash balances, and T is the total volume of goods and services purchased during a year by the community. If we take P as the value of money instead of the price level as in Pigou equation, then Robertson equation exactly resembles Pigou. P is equal to KT divided by M. Next one, Keynesian equation. About the Keynesian equation, what it represents to the quantity theory of money. Keynes, in his A Track on Monetary Reform, 1923, gave his real balance quantity equation as an improvement over the other Cambridge equations. According to him, people always want to have some purchasing power to finance their day-to-day transactions. The amount of purchasing power depends partly on their tastes and habits, and partly on their money is given. This demand for money is measured by consumption units. A consumption unit is expressed as a basket of standard articles of consumption or other objects of expenditure. Money demanded and supplied and value of money, if K is the number of consumption units in the form of cash. N is the total currency in circulation and P is the price for consumption units, then the equation. Students, please attention to that subject. N is equal to Pk. If K is a constant, a proportionate increase in N will lead to a proportionate increase in price. This equation can be expanded by taking into account bank deposits. Let K be the number of consumption units in the form of bank deposits and R the cash reserve ratio of banks. Then the expanded equation is N is equal to P in brackets K plus RK. Again, if K dash and real constant, P will change in exact proportion to the change in N. Keynes regards his equation superior other cash balances equation. The other equations fail to point how the price level can be regulated. Since the cash balance K held by the people are outside the control of the monetary authority, P can be regulated by controlling N and R. It is also possible to regulate bank deposits K by appropriate changes in the bank rate. So P can be controlled by making appropriate changes in N or K so as to offset changes in K. For the following cash balance approach, this is figure. This figure shows that the cash balance approach image. Uh, are you observed to the this figure cash balance? And then you can see that cash balance approach quantity theory of money. This is images. And then Keynesian quantity theory of money, cash balance approach, Cambridge version, QTM. Then lastly, we have discussed as criticisms of the cash balance approach. The cash balance approach to the quantity theory of money has been criticized on the following grounds or counts. First one, truisms. Like the transaction equations, the cash balance equations or truisms, take any Cambridge equation, Marshall P is equal to M divided by KY, or Pigu P is equal to KR divided by M, or Robertson P is equal to M divided by the KT, or Keynes P is equal to N divided by K. It establishes a proportionate relation between quantity of money and price level. And second assumption, price level does not measure the purchasing power. Keynes in his treatise on money 1930 criticized Pigou cash balance equation and also his own real balances equation. He pointed out that measuring the price level in wheat as a Pigou did or in terms of consumption units as Keynes himself did was a serious defect. The price level in both equations does not measure the purchasing power of money. Measuring the price level in consumption units implies that cash deposits are used only for expenditure on current consumption. But in fact, that they are held for a vast multiplicity of business and personal purposes. By ignoring these aspects, the Cambridge economists have committed a serious mistake. And third criticism, more importance to total deposits. Another defect of the Cambridge equation lies in its applying to the total deposits consideration, which are primarily relevant only to the income deposits, and the importance attached to K is misleading when it is extended beyond the income deposits. Fourth criticisms, neglects other factors. Further, the cash balance equation does not tell about changes in the price level due to changes in the proportion in which deposits are held for income, business and savings purposes. Next, fifth one, neglect of saving investment effects. Moreover, it fails to analyze variations in price level due to saving investment inequality in the money. Sixth criticism, K and Y not constant. The Cambridge equation, like the transaction equation, assumes K and as a constant. This is unrealistic because it is not essential that the cash balances and the income of the people should remain constant even during the short period. And the seventh criticism, fails to explain dynamic behaviors of prices. The theory argues that changes in the quantity of money influence the general price level proportionally the but facts that is a quantity of money influence the price level in an essential, erratic, and unpredictable way. Further, it fails to point out that the extent of change in the price level as a result of a given change in the quantity of money in the short period. Thus, it fails to explain the dynamic behavior of prices. Eighth criticisms neglects interest rate. The cash balances approach is also weak in that it ignores other influences such as the rate of interest, which exerts a decisive and the significant influence upon the price level. As pointed out by Keynes in the general theory, the relation between quantity of money and the price level is not direct but indirect, the rate of interest. Investment, output, employment, and income. This is what the Cambridge equation ignores and hence fails to integrate monetary theory with the theory of value and output. Ninth criticism, last criticism. Demand for money, not interest, inelastic. The neglect of the rate of interest as a causative factor between the quantity of money and the price level led to the assumption that the demand for money is interest inelastic. It means that money performance only the function of medium of exchange and does not possess any utility of its own, such as a store of value. And next one, neglect of goods markets. Further, the omission of the influence of the rate of interest in the cash balance approach led to the failure of neoclassical economics to recognize the interdependence between the commodity and money market. According to the Potnikin, they led an undue concentration on the money market, a corresponding neglect of the commodity markets, and a resulting demonizing of the analysis of the effects of monetary changes. Next one, neglects real balance effects. Potnikin has criticized the Cambridge economics for their failure to integrate the goods market and the money markets. This is borne out by the dichotomy which they maintain between the two markets. The dichotomization implies that the absolute price level in the economy is determined by the demand and supply of money, and the relative price level is determined by demand and supply of goods. The cash balance approach keeps the two markets rigidly apart. For instance, this approach tells that an increase in the quantity of money leads to an increase in the absolute price level, but exercises no influence on the market for goods. This is the because of the failure of Cambridge economics to recognize the real balance effect. The real balance effect shows that a change in the absolute level does not influence the demand and supply of goods. The weakness of cash balances approach lies in ignoring this. And next criticism, elasticity of demand for money in it, money not in it. The cash balance theory established that the elasticity of demand for money is unity, which implies that increase in the demand for money leads to a proportionate decrease in the price level. Potnikin holds that the Cambridge function does not imply uniform elasticity. According to him, this is because of the failure of Cambridge economics to recognize the full implications of the real balance effects. Students, the Potkin argues that a change in price level will cause a real balance effect. For instance, a fail in the price level will increase the real value of cash balances held by the people. So, when there is excess demand for money, the demand for goods and services is reduced. In this case, the real balance effect will not cause a proportionate but non-proportionate change in demand for money. Thus, the elasticity of demand for money will not be unity. And lastly, neglects speculative demand for money. Another serious weakness of cash balance approach is its failure to consider the speculative demand for money, the neglect of the speculative demand for cash balance to makes the demand for money exclusively depend on money income, thereby again neglecting the role of the rate of interest and the store of value function of money. We have concluded that this is one of the most important theory for your annual examination. You can systematically observe for this video. Will prepare notes and so properly understanding this quantity theory of money. Are you systematically observe these videos? Thank you, one and all.